Most traders think pyramiding means adding more when they're winning. They're catastrophically wrong. Here's the brutal truth that trading educators won't tell you. 95% of traders who attempt to scale into winning positions end up giving back every penny of profit, and then some. They transform winners into losers because they pyramid like amateurs, not professionals. Jesse Livermore learned this lesson the expensive way, and it cost him exactly $2 million. After brilliantly shorting the 1907 panic, he kept adding full positions as stocks fell further. Each edition felt safer because he was winning. Each edition felt logical because the trend was intact. When J.P. Morgan stepped in to stabilize markets, Livermore's massive pyramid crushed him like a house of cards. His brilliant short became a devastating loss because he violated the cardinal rule of safe scaling. This wasn't bad luck or market manipulation. This was mathematical inevitability disguised as opportunity. Livermore. Thanks for watching. And ckeinsen.org Ziston had built what professionals call a reverse pyramid. Each edition larger or equal to the last. Each layer more dangerous than the foundation below. When that foundation cracked under Morgan's intervention, the entire structure collapsed with devastating precision. The mathematics are brutal and unforgiving, yet most traders never run the numbers until their account balance teaches them the hard way. Amateurs pyramid up, adding equal or larger positions at higher prices because it feels safe when you're winning. Professionals pyramid down, each edition smaller than the last, preserving favorable average costs and compressing risk. The difference isn't just strategy. It's survival mathematics that determines whether scaling builds wealth or destroys capital. Picture this scenario that plays out thousands of times daily across trading screens worldwide. You buy 1,000 shares at $50 after spotting a clean breakout. Stock ticks to $60, showing you a quick $10,000 profit. Dopamine floods your system, confidence soars, and you add another 1,000 shares because you're playing with house money. Price runs to $70, confirming your brilliance, so you add another 1,000 shares. Why not? The trend is your friend, right? Here's the mathematics that just destroyed your edge. Your average cost is now $60 per share. You need the stock above $60 just to break even on your total position. Your original $50 winner that showed 40% gains now needs 20% movement just to stay flat. One normal pullback to $55, a mere 7% decline, and you're underwater on a winning trade. Your $10 winner per share became a $5 loser per share because you pyramided up like an amateur. The psychology behind this disaster is predictable and exploitable by the market, not by you. You're winning. Endorphins surge, fear disappears, and suddenly that next edition feels like free money. The market is confirming your genius. So why not get bigger? This emotional hijacking transforms systematic traders into gamblers faster than any losing streak ever could. Consider the identity shift required here. Amateurs crave action and confirmation of self-worth through position size. Professionals require confirmation of market structure through price and volume. The amateur asks, "How big can I get?" The professional asks, "How safe can I build?" That single mental swap transforms reckless pyramiding into engineered position construction. Professional money managers understand something that destroys amateur accounts. Each edition is a completely new trade, requiring fresh confirmation. They don't add because they feel good about existing profits. They add because the market passes specific tests that most traders never learn to recognize. The tape must show absorption, not distribution. Volume must expand on breakouts, contract on pullbacks. Supply must be absent at critical levels. But here's Livermore's counterintuitive promise that will reshape how you think about scaling forever. Done correctly, your second edition will feel safer than your first entry. Impossible? Not when you understand his three-step pyramiding test. This isn't motivational speaking, this is mathematical reality based on how the market pays for your patience and precision. Step 1 will shock you because it goes against every instinct about winning trades. While amateurs add because they're excited about paper profits, Professionals add only after the market pays them a specific price for the privilege. The profit test isn't about your feelings. It's about market confirmation that 80% of traders never wait to receive. Your position must show at least +1 R profit before any thought of adding more size. Step 2 involves mathematics that most traders never calculate because they're too focused on potential gains to measure actual risk. The risk compression test ensures that as your position grows, your total dollar risk shrinks, not expands. This mathematical gate separates casual traders from professional position builders, and the calculations take less than 60 seconds to complete correctly. Step 3 reveals the precise moment to stop building before your pyramid collapses under its own weight. The reaction test teaches you to read the market's natural breathing: expansion, contraction, expansion. Most traders keep adding until the market forces them to stop through devastating reversals. Professionals stop adding while they're still in control, not when control is taken away. The hidden rule that governs all professional pyramiding: waiting is a position. This maxim sounds passive, but it's the most active decision you can make in volatile markets. While amateurs frantically add to every uptick, professionals wait for specific confirmations that filter out noise and amplify edge. If any step fails its precise criteria, you do nothing. Not do less or modify the plan. You do absolutely nothing. This binary approach eliminates the gray areas where amateur judgment destroys professional discipline. Each gate filters out emotion and randomness, leaving only the highest probability scaling opportunities that compound wealth instead of destroying it. The tape tells you everything about whether your pyramid deserves another layer, but only if you know the language. It shows absorption versus distribution, demand versus supply, strength versus weakness. Most traders pyramid blind, adding on hope instead of proof, feeling instead of confirmation. Master these 3 gates, and you'll transform scaling from an account killer into a wealth builder. The mathematics aren't complex, but they're precise. Every professional position builder knows these numbers by heart, because they're the difference between systematic wealth building and systematic wealth destruction. Your transformation from amateur to professional pyramider begins with understanding one fundamental truth. The market doesn't reward hope, excitement, or confidence. It only rewards discipline, patience, and mathematical precision. Everything else is expensive entertainment disguised as investing. In 60 seconds, we'll reveal the exact moment Livermore allowed his first edition, and it wasn't when he felt confident about his profits. You don't go big, you go right. This fundamental shift in mindset separates every professional from every amateur who ever destroyed an account through reckless scaling. Step 1 is the profit test, and it demands that your pilot position prove the idea before you risk $1 additional of capital. This isn't about lacking conviction, it's about respecting the mathematical reality that most trade ideas fail, even the ones that feel absolutely certain. Start with 0.5% to 1% of your account, not because you're scared or uncertain, but because you understand that uncertainty is the only certainty in markets. Your pilot position serves as your market scout, testing enemy territory before you commit the full battalion. This small size isn't timidity, it's tactical intelligence that keeps you alive when the market turns hostile without warning. Place your stop loss below the pivotal point, that critical level that separates hope from mathematical reality. The pivotal point isn't arbitrary, it's where supply overwhelmed demand on the way up, creating resistance that must be cleared with conviction for your idea to remain valid. Below this level, your trade thesis is wrong, regardless of how you feel about it or how much you want it to work. Now comes the hardest part for most traders. You wait. You're not hunting excitement, adrenaline, or the next dopamine hit from adding size. You're hunting confirmation that the market agrees with your analysis. This waiting period filters out 90% of bad scaling decisions because most traders can't tolerate the uncertainty between entry and confirmation. The rule is ironclad and admits no exceptions. Only add when your position shows at least +1 R open profit and price. Clears the pivotal point with conviction. That means strong tape action showing absorption of supply, above average volume confirming genuine demand, and no heavy selling pressure that indicates distribution masquerading as accumulation. The +1R requirement isn't arbitrary, it's mathematical insurance. If you risk $1,000 on your pilot position, and it shows +1R profit, you're up $1,000. This profit cushion means the market has already paid you the down payment for considering additional risk. Without this buffer, you're adding to a position that hasn't earned the right to grow. Watch Sarah build her Apple pyramid with professional precision. She identifies $120 as her entry after Apple breaks above a 3-week consolidation. Her stop goes at $117, below the $118 pivot point that held as support during the base. Risk per share, $3. She buys 500 shares, risking exactly $1,500 on her $150,000. Account precisely 1% as planned. Most amateurs would add immediately if the stock popped to $122 or $123, excited by quick profits and eager to maximize the opportunity. Sarah does nothing. She waits for her criteria to align like tumblers in a lock. Price must clear the $130 level, her next major resistance, with volume and tape confirmation. 3 trading days later, Apple gaps up on earnings and trades through $135, clearing the $130 pivot on volume. That's 40% higher than the 20-day average. The tape shows consistent buying pressure with minimal selling into the strength. Bids are absorbing any offers cleanly, and the stock isn't struggling at resistance, it's clearing it with authority. Now Sarah has her confirmation. Her pilot position shows $7,500 profit on the 500 shares, exactly +5R, well above her +1R minimum threshold. The pivotal point is cleared with conviction. Volume confirms institutional participation, not just retail enthusiasm. The tape shows demand overwhelming supply, with no heavy blocks being dumped into the rally. She adds 375 shares at $135, notably smaller than her 500-share pilot position. This isn't hesitation or lack of confidence. This is professional position construction that maintains favorable average cost, while building size systematically. Her new average cost is $126.43 across 875 shares, still well below current market price. The mathematics reveal professional thinking. Her original $1,500 risk generated $7,500 in open profit. She's adding $1,125 in additional capital at a price already validated by market action. She's not chasing, she's building on confirmed strength with smaller size. Here's what separates this addition from amateur gambling. Sarah added its strength, not on a dip. Amateurs wait for pullbacks to get a better price, but pullbacks often signal the beginning of reversals. Professionals add when the market proves their thesis correct through higher prices and confirming action. The takeaway crystallizes the entire philosophy. Professionals make the market pay the down payment on the forward. Next edition. They don't add because they're bored, excited, or convinced they're right. They add because the market has mathematically compensated them for the additional risk through open profits and structural confirmation. Amateurs add based on emotions, excitement about profits, fear of missing out, or confidence in their analysis. These emotional triggers create the exact conditions that transform winning trades into devastating losses. The profit test filters emotion with cold mathematics that doesn't care about your feelings or predictions. Pattern interrupt. Doing nothing is sometimes the best trade you'll ever make. This maxim challenges every action-oriented instinct that drives most traders toward constant activity. If price hesitates at the pivotal point instead of clearing it with authority, no addition. If volume is weak or declining during the breakout, no addition. If the tape shows selling into strength offers, appearing faster than bids can absorb, then absolutely no addition. Waiting is a position, and often it's the most profitable position you can hold. While amateurs frantically add to every uptick, professionals wait for the market to meet their specific criteria. This patience isn't passive, it's the most active decision you can make because it requires constant evaluation and the discipline to reject marginal opportunities. The tape tells you everything about whether your addition is justified, but only if you understand its language. Heavy volume on breakouts with minimal selling pressure indicates institutional accumulation. Light volume with heavy selling into any strength suggests distribution. Strong tape means you see bids absorbing offers cleanly, price moving upward with ease, without stuttering or showing significant selling pressure. Consider the identity transformation required here. You're not a gambler hoping for the best outcome. You're not an optimist believing in your predictions. You're a systematic trader who only acts when mathematical and structural criteria align perfectly. This shift from hope-based to proof-based decision-making separates professionals from the 95% who fail at pyramiding. Every professional position builder understands that the second edition is actually a completely separate trade requiring fresh confirmation. It's not a continuation of the first trade, it's a new decision based on new information that the market has provided through price and volume action. Add on proof, not hope. Make the market pay the down payment. Respect the pivot. Respect the tape. Respect the mathematics. Your written protocol should read: pilot size 0.5, 1% risk, stop under pivot, wait for +1R and pivot clearance on 30-50% higher volume. Tape must show demand absorbing supply. Only then consider a smaller add-on strength. Here's the twist that separates professionals from pretenders who think they understand position building. Your second edition must not increase your total dollar risk. This mathematical requirement seems impossible to most traders because they never calculate the numbers correctly. They feel good about paper profits and unconsciously drown themselves in oversized positions. Most traders never run these calculations because they're too focused on potential gains to measure actual risk exposure. They see profits and assume safety. But profits don't reduce risk. Proper position sizing and stop management reduce risk. This mathematical gate is where 80% of traders fail catastrophically, and where the remaining 20% build sustainable wealth. The numbers don't lie, but they require calculation and discipline to implement correctly. In 60 seconds, we'll reveal exactly how to ensure your growing position actually reduces your risk instead of amplifying it through the risk compression test. Proof isn't enough. Safety is mandatory. This harsh reality separates every professional from every amateur who ever destroyed an account through seemingly successful trades. Step 2 is the risk compression test, and it demands mathematical precision that most traders never calculate until their account balance teaches them the expensive lesson. After you add to any position, your total dollar risk must equal or be less than your original risk budget. If it grows by even $1, you failed the test and your pyramid becomes a death trap waiting for the next normal market pullback. This isn't theoretical risk management, this is survival mathematics that determines whether scaling builds wealth or destroys capital. Here's the mathematics that separate professionals from casualties. Your trading account holds $100,000. Your risk per trade is 0.75%, exactly $750 per position. You initiate a pilot position of 300 shares at $50 with a stop at $47.50, risking $2.50 per share for total exposure of $750. Price moves to $52.50, showing +1R profit and confirming above the $50 pivotal point with strong volume and clean tape action. Every amateur instinct screams to add size because you're winning. You decide to add 200 shares at current strength, bringing your total to 500 shares. Now comes the crucial calculation that 80% of traders never perform. You must establish a new stop for the entire 500-share position. Your new average price across all shares is $51. If you place your stop at $48.25, still above your original entry but below the pivot, your risk per share becomes $2.75. Total risk calculation: 500 shares multiplied by $2.75 equals $1,375. This exceeds your $750 budget by 83%. You failed the risk compression test catastrophically. The mathematics are binary: pass or fail. You have exactly three options. First, tighten your stop to compress risk. To maintain $750 total risk across 500 shares, your maximum risk per share can only be $1.50. This requires placing your stop at $49.50, demanding the market hold much stronger support. Second, reduce your addition size. With a $2.75 stop distance, you can only hold 272 shares total within your $750 budget. Since you already own 300, you cannot add any shares. Third, cancel the addition entirely and wait for better structure. Watch Tom's disaster unfold because his mistake repeats daily across trading screens worldwide. He buys 400 shares at $25 with a $2 stop, risking $800 on his account. Stock moves to $28, showing clean profits. Excited by quick gains, he adds 300 shares without recalculating risk exposure. His original stop remains at $23, but now he holds 700 shares. His total risk jumped from $800 to $1,400, a 75% increase. He never calculated because he focused on profits, not mathematics. When a normal 8% pullback brings the stock to $25.75, it hits his original stop, and he's forced out for a small loss. 2 days later, the stock rockets to $35. Tom wasn't wrong about direction, he was wrong about mathematics. His oversized position couldn't withstand normal volatility that his original position would have survived easily. The protocol eliminates emotional decision-making through 3 mandatory calculations performed before any addition. First, calculate your new average price across all shares. Second, determine your new stop level for the entire position, placed under the most recent pivotal point acting as support. Third, compute total dollar risk by multiplying total shares by the distance from average price to stop. If total risk exceeds your original budget, you have 2 choices: cancel the addition or reduce size until risk compresses. There's no negotiation, no close enough, no emotional override. The mathematics are absolute. This creates a paradox that confuses most traders. As your position grows larger, your total risk must shrink smaller. This inverse relationship seems impossible until you understand that higher prices allow tighter stops, reducing per share risk even as share count increases. Professional pyramiding creates a mathematical net that tightens as position size grows. Your $50. The pilot with a $2.50 stop carries $2.50 per share risk. When price reaches $55 and establishes new support at $52, your stop can move to $51.50, reducing per share risk to $3.50. Despite higher stock price, this compression allows adding shares while maintaining or reducing total exposure. The amateur sees higher prices and assumes higher risk. The professional sees higher prices as opportunities for tighter stops and compressed risk. This fundamental difference determines whether scaling builds wealth or destroys it through mathematical inevitability disguised as bad luck. Consider the identity transformation required here. You're not a gambler trying to maximize this single opportunity. You're a systematic trader, building positions according to mathematical rules that preserve capital while capturing trends. Every addition creates a completely new risk profile that must meet your criteria independently. Professional money managers understand that unrealized gains provide no protection against position sizing errors. They don't add because they're winning. They add because the new risk profile passes their mathematical tests. Paper profits are loans the market can call at any time. Your job is ensuring that as you borrow more size, the loan balance shrinks, not swells. The risk compression test destroys fear and greed at their source. Fear fades because you're never overexposed. Even if stopped, you lose no more than your budget. Greed is contained because maximum size is always a function of stop distance, not desire. This is why professionals sleep while amateurs stare at screens, bargaining with every tick. 2 iron rules keep you honest when emotions surge. Rule 1. Never add if total dollar risk increases above original budget. If compression fails, size doesn't progress. Rule 2. Never defend a larger position with a weaker stop. Your stop must sit where the thesis fails, not where you'll feel okay if hit. Position size follows stop distance. Stops follow structure. Structure follows the tape. If any link weakens, you do nothing. Doing nothing is a professional decision that preserves capital for the next high probability opportunity. The maxim that governs all professional pyramiding. If the risk doesn't compress, the size doesn't progress. This isn't negotiable or situational. It's mathematical law that admits no exceptions. Violate it once, and you transform systematic position building into random gambling with predictably catastrophic results. We've established that your pilot must prove itself and your additions must compress risk. But markets don't move in straight lines, they breathe through expansion, contraction, and expansion again. One final gate remains that most traders ignore: how the market's natural breathing patterns determine when to make your final addition and when to stop building entirely. Strength needs a test. Every rally, no matter how powerful, must prove it can withstand the market's natural breathing before earning additional capital. Step 3 is the reaction test, and it separates sustainable trends from temporary surges that collapse under their own momentum. After your second edition, you wait for the market's natural exhale, not because you lack confidence, but because you understand that healthy trends digest gains before continuing higher. Every trend breathes through predictable cycles: expansion, contraction, expansion. This isn't market theory. It's mathematical reality based on how institutions accumulate and distribute positions. The expansion phase attracts momentum traders and retail enthusiasm. The contraction phase shakes out weak hands and tests conviction. The next expansion phase, if it comes, validates the underlying strength and justifies additional risk. You're watching two critical elements during this breathing cycle: depth and character. Both must align perfectly before you risk additional capital, because one without the other signals weakness, disguised as strength. Depth measures how far price retraces from recent highs. Character reveals who's buying and selling during the pullback through volume patterns and tape action. Depth requires mathematical precision, not emotional interpretation. The pullback should hold above your last edition price or, at minimum, above the pivotal point now acting as support. If price falls below your most recent add, the market is telling you that level attracted sellers, not buyers. If it breaks the pivot that confirmed your second edition, the entire structure becomes suspect. This isn't negotiable, it's binary mathematics that admits no gray areas or hopeful interpretations. Character demands reading the tape like a professional, not hoping like an amateur. Lighter volume on the decline indicates natural profit-taking, not institutional distribution. Heavier volume on the resume shows fresh buying interest overwhelming any remaining selling pressure. The tape should reveal bids, absorbing supply cleanly, not offers chasing price lower in panic or desperation. Watch Marcus build his Tesla pyramid with surgical precision through 3 distinct phases. His pilot position at $180, with a stop at $175, risked exactly $1,000 on his $200,000 account. When price cleared, the $190 pivot on strong volume and reached $220, showing plus 8R profit. He added 150 shares smaller than his original 200-share pilot. His risk compressed from $1,000 to $900 total exposure. At $240, with his position showing substantial profits and the $230 pivot holding as support, Marcus added his second unit of 100 shares, again smaller than the previous edition. His average cost across all 450 shares was $206.67, well below current market price. His stop sat at $228, keeping total risk at $875 despite holding 2.25 times his original position size. Price ran immediately to $255, validating his systematic approach with quick profits. Then came the critical test that determines whether trends continue or collapse, the natural reaction that every healthy trend must demonstrate. Tesla pulled back over 3 trading days to $242, holding cleanly above Marcus's $240 addition level. The mathematics of this pullback revealed everything about the stock's internal strength. The decline measured only 5.1% from the $255 high, shallow enough to maintain the uptrend structure. Volume during the 3-day decline averaged 60% of the previous 20-day average, indicating natural profit-taking rather than institutional selling. Most importantly, price held above his most recent addition, proving that $240 attracted buyers, not sellers. Character analysis confirmed what depth suggested. This was healthy digestion, not distribution. The tape showed consistent bids, absorbing any selling pressure without panic or urgency. Offers weren't chasing price lower, they appeared at specific levels and were absorbed cleanly. No heavy blocks were being dumped into the market, and the stock showed no signs of struggling to maintain support levels. When Tesla resumed its advance on day 4, volume surged 40% above average, as price cleared the $255 previous high. The breakout showed conviction, not hesitation. Institutional buying was overwhelming any remaining selling pressure with authority. This combination, proper depth, healthy character, and strong resume, earned Marcus his final addition. He added 100 shares at $256, exactly half his second addition of 200 shares. Maintaining the professional pyramid structure, where each layer grows smaller, his total position now held 550 shares with an average cost of $211.64. Immediately after adding, he moved his stop to $238, 2 points below the reaction low, keeping his total risk compressed at $850. This systematic approach created the paradox that confuses most traders. Marcus felt safer, adding his fourth layer at $256, than he did buying his first shares at $180. The mathematics explain why. Each addition was funded by market-generated profits. Each layer was smaller than the last, each stop was tighter than before, and each decision was confirmed by specific criteria rather than emotion. If the reaction had been ugly wide bars down, volume expansion during the decline, tape showing heavy supply, overwhelming demand, Marcus would have made a different decision entirely. No addition. Instead, he would have considered peeling his top layer to lock profits and preserve mental capital for the next opportunity. Ugly reactions reveal internal weakness that no amount of optimism can overcome. Wide bars indicate panic or institutional selling. Volume expansion during declines shows distribution, not accumulation. Tape action showing offers chasing bids, lower suggests fear, overwhelming greed. These signals demand defensive action, not aggressive position building. Remember the maxim that governs all professional decision-making. Not adding is still pyramiding into your edge, not into market noise. While amateurs feel compelled to act on every price movement, professionals understand that waiting for proper confirmations is the most profitable action they can take. Patience isn't passive, it's active capital preservation. The amateur treats pyramiding like a video game, adding to every uptick, because action feels productive and inaction feels wasteful. The professional demands 3 confirmations in sequence: profit, compression, reaction. Each gate filters out emotion and randomness, leaving only the highest probability opportunities that compound wealth instead of destroying it. Consider the identity transformation required to implement this systematic approach consistently. You're not trading hope, hunches, or emotional impulses. You're trading confirmed strength with compressed risk and validated reactions. This shift from feeling-based to fact-based decision-making separates professionals from the 95% who fail at position building. Your pilot position proves the idea through +1R, profits and pivot clearance. Your second edition compresses risk while building size on confirmed strength. Your final edition waits for the market to digest gains and resume higher with conviction. Each layer requires fresh confirmation. You're not building on momentum. You're building on mathematical validation. Close the nested loop that opened this entire discussion. This is precisely why your second edition feels safer than your first entry. Each layer tightens the mathematical net, while the market pays for your size through confirmed profits and structural validation. Your risk decreases as your position grows because higher prices allow tighter stops and better average costs. The systematic approach transforms pyramiding from gambling into calculated position building that professionals use to compound wealth over decades. Every addition is a separate trade, requiring separate confirmation. Every layer must pass independent tests. Every decision filters emotion through mathematics. One final protocol awaits how to synthesize these three tests into a battle-ready checklist that works when emotions run high and opportunities demand immediate decisions. Knowledge without process fails under pressure. Every trader who ever destroyed an account through poor pyramiding knew the theory, but lacked the systematic protocol to implement it. When emotions surged and opportunities demanded split-second decisions, here's your battle-tested protocol. The three-step pyramiding test condensed into a 60-second checklist that works precisely when your heart rate spikes and thinking time disappears. This isn't theoretical framework, this is operational procedure designed for real-time execution when markets move fast and amateur instincts scream for action. Every question demands a binary answer. Every decision gate eliminates emotional override. Every calculation takes seconds, not minutes. Professionals live inside checklists. Amateurs live inside feelings. Step 1 is the profit test, and it admits no negotiation. Is your pilot position showing at least +1 R open profit? This isn't approximate. It's mathematical fact. If you risked $1 on entry, you need $1 in open profit minimum. If your position shows +0.8 R, the answer is no, regardless of how close it feels or how confident you are about direction. Did price clear the pivotal point with genuine confirmation? Check 3 elements in sequence. Tape strength showing bids absorbing offers cleanly, volume running 30–50% above the 20-day average, and no heavy supply appearing as price advances. If the tape shows hesitation, volume is weak, or large blocks are being sold into strength, the answer is no. Watch Sarah execute this correctly. She buys 500 shares of Apple at $120 with a $3 stop, risking $1,500 on her $150,000 account. Price rises to $135, showing $7,500. Profit exactly, +5 R, well above the +1 R minimum. Price cleared the $130 pivot on 40% higher volume with clean tape action. Both conditions met. Proceed to size calculation. Yes to both conditions. Proceed immediately to risk compression. No to either condition. Wait and maintain pilot position only. There's no middle ground. No maybe. No emotional override. The mathematics are binary, and your survival depends on respecting them absolutely. Step 2 is the risk compression test, where mathematics separate professionals from casualties. Calculate your new stop level for all shares, placed under the pivot point that's now acting as support. This isn't where you hope the stock will hold, it's where your thesis becomes invalid if breached. Compute total dollar risk by multiplying total shares by the distance from average price to your new stop level. Does your total risk equal or remain below your original risk budget? Here's the calculation that destroys amateur accounts. Your $100,000 account risks 0.75% per trade, exactly $750. You bought 300 shares at $50 with a $2.50. Stop risking $750. Price moves to $52.50, confirming above the $50 pivot. You plan to add 200 shares. New average price across 500 shares, $51. New stop under the pivot at $49.75. Risk per share, $1.25. Total risk, 500 shares times $1.25 equals $625. This compresses below your original $750 budget test passed. Execute the smaller addition of 200 shares. maintaining the pyramid down structure. If total risk exceeded your budget, you have two choices: reduce edition size until risk compresses, or cancel entirely. Sarah adds 375 shares at $135 smaller than her 500-share pilot. Her new average becomes $126.43 across 875 shares. Her stop moves to $132, keeping total risk compressed below her original budget. This mathematical gate destroys more amateur accounts than any other single mistake. They feel good about profits and unconsciously drown in oversized positions that can't withstand normal market volatility. Your calculator doesn't care about your emotions, it only reveals mathematical reality. Step 3 is the reaction test, completing the safety circuit. After your second edition, you wait for the market's natural pullback, not because you lack confidence, but because healthy trends must prove they can digest gains before continuing higher. You're evaluating depth and character with surgical precision. Depth means the pullback holds above your last edition price, or, at minimum, above the pivotal point now acting as support. Character means lighter volume on the decline and heavier volume on the resume, with tape showing bids absorbing supply rather than offers chasing price lower. Marcus built his Tesla pyramid through $180 and $220, adding his second unit at $240. Price ran to $255, then pulled back 3 days to $242, holding above his $240 addition on 60% of average volume. When it resumed to new highs on a volume surge, Marcus earned his final addition, 100 shares, exactly half his second add of 200 shares. If the reaction is ugly, wide bars down, volume expansion during decline, tape showing supply, overwhelming demand, no addition. Consider peeling your top layer to lock profits and preserve mental capital. Remember, not adding is still pyramiding into your edge, not into market noise. The guardrails that keep you alive when emotions surge. Maximum 3 additions total. Each addition must be smaller than the previous layer. No exceptions. Never widen stops after adding size. Stops only tighten or remain unchanged if structure doesn't improve. Waiting is always a position, often the most profitable position you can hold. Risk 0.5% to 1% per trade. Initially, not because you lack conviction, but because you respect uncertainty and preserve capital for inevitable mistakes. Total position rarely exceeds 2% to 3% of account risk, regardless of how certain the opportunity appears. Numbers that matter. First edition only at +1R minimum profit with pivot clearance confirmed. Second edition only if total risk compresses below original budget. Final edition. Final edition. Only after valid reaction that holds structure and resumes with conviction. The professional's mantras that anchor correct behavior. Proof. Then progress. Never add on hope without market confirmation. Add on strength, peel on weakness, scale into what's working. Your best trade is sometimes the wait. Patience isn't passive, it's active capital preservation. Run the protocol aloud to slow your pulse. Pilot +1R, pivot cleared with confirmation, tape firm, volume above average, risk compressed to budget. The active naming criteria reduces cognitive load and snaps you out of the profit trance. If anything feels ambiguous, treat it as no. Ambiguity is expensive. Consider the identity transformation required. You're not a gambler chasing adrenaline. You're not an optimist hoping for the best. You're a systematic trader who only acts when mathematical and structural criteria align perfectly, filtering emotion through proven mathematics that preserve capital while capturing trends. We opened asking how the second edition could feel safer than the first. Now you know. The market funds your size through confirmed profits, while mathematics compress your risk. Each layer tightens the net while higher prices allow tighter stops and better average costs. Your pilot proves the idea. Your second edition compresses risk. Your final edition validates the trend's health. Cut losses fast before they become disasters. Size small to survive inevitable mistakes. Wait for unambiguous confirmation before committing capital. Own your process. not your predictions, because markets reward discipline and mathematical precision, not hope or excitement. Master these three gates, and you'll transform scaling from account killer into wealth builder through systematic position construction that professionals use to compound capital over decades. Jesse Livermore's greatest pyramid lesson came not from his biggest win, but from his most disciplined restraint. In 1929, while everyone else pyramided into the bubble that would define a generation, he sat in cash, watching fortunes being built on borrowed time and mathematical impossibility. When the crash came with devastating precision, he was positioned to pyramid short safely, systematically, profitably, while others saw their leveraged dreams collapse into financial ruin. That's the master lesson that separates legends from footnotes. Knowing when not to pyramid is infinitely more valuable than knowing how to build positions. This restraint isn't weakness or indecision. It's the ultimate expression of professional discipline that preserves capital for the opportunities that truly matter. The amateur sees every winner as a pyramiding opportunity, treating position building like a reflex rather than a calculated decision. The professional sees pyramiding as a rare privilege reserved for the highest probability setups, with the cleanest confirmations and the most favorable risk-reward mathematics. Consider the mathematics of restraint that amateur traders never calculate. If you avoid 10 marginal pyramiding opportunities that would have generated 3% losses each, you've preserved 30% of capital for the single opportunity that generates 40% gains. The professional's edge isn't finding more opportunities. It's avoiding the wrong ones with surgical precision. Your three gates are now installed. Proof test, compression test, reaction test. These aren't suggestions for consideration when convenient. They're survival protocols in a game that destroys accounts daily through seemingly reasonable decisions that violate mathematical reality. But here's what most traders miss about Livermore's legendary approach. He spent significantly more time waiting for the right opportunity than building pyramids. Patience wasn't just virtue in his methodology, it was literally his position, generating profits through preserved capital and avoided losses. The conditions that invalidate pyramiding are specific and non-negotiable. First, never add when the tape turns choppy, with inconsistent prints, poor follow-through, and obvious selling into strength. Second, avoid adding when there's no clean pivotal point converting from resistance into reliable support through volume confirmation. Third, never add ahead of binary events like earnings or regulatory rulings that distort normal behavior and liquidity. Fourth, avoid adding in illiquid names where spreads widen and slippage explodes overnight. Fifth, never add when your stop would need widening to accommodate volatility professionals. Never widen stops under any circumstances. Sixth, avoid adding when position size already consumes maximum risk budget, even if profits flash green. Seventh, avoid adding if your journal shows emotional triggers today: boredom, revenge, fear of missing out, or euphoria creeping in. Eighth, avoid adding when broader market deteriorates with distribution days stacking across sectors. Watch Dana navigate this correctly during a furious sector rotation. Yesterday's leaders stalled, new breakouts failed on weak volume, and the tape showed more supply than demand. She maintained her pilot position in one name showing relative strength but refused three tempting upticks because volume betrayed conviction completely. When rotation settled and real institutional demand returned 2 weeks later, she added one smaller than her pilot, with stops under pivot support. Her patience paid in multiples. Earlier additions would have triggered cascading stops during the noise. The difference between amateur hope and professional discipline isn't complex, but it requires fundamental identity transformation. Amateurs pyramid their emotions, adding because they feel good about paper profits, excited about momentum, or greedy about potential gains. These emotional triggers create the exact conditions that transform winning trades into devastating losses through oversized positions that can't withstand normal market volatility. Professionals pyramid their mathematical edge, adding only when mathematics, tape action, and market structure align perfectly according to predetermined criteria that admit no emotional override. They don't add because they feel confident. They add because the market has paid them the down payment through confirmed profits and structural validation. The amateur asks, "How much can I make if I'm right?" The professional asks, "How much can I lose if I'm wrong? And can I survive that loss mathematically and psychologically?" This single mental shift transforms reckless pyramiding into systematic wealth building that compounds over decades rather than destroying accounts in weeks. Remember the identity shift that governs every decision. You're not a gambler chasing the next adrenaline high or trying to prove your market predictions correct. You're a systematic trader who respects capital preservation above all else, understanding that staying in the game is prerequisite to winning the game. Your ego isn't attached to being right about market direction. It's attached to following your process with mathematical precision. You cut losses fast before they become disasters that require months of perfect trades to recover. Most traders hold losing positions too long because admitting mistake feels like admitting failure. Professionals understand that small losses are tuition payments in the world's most expensive education, while large losses are account killers that end careers. You size positions small to survive the inevitable mistakes that every trader makes regardless of experience or skill level. Position sizing is the only factor completely under your control. You can't control market direction, timing, or volatility, but you can always control how much you risk per trade. You wait for unambiguous confirmation before committing additional capital to any position. Ambiguity is expensive because it allows emotional interpretation to override mathematical reality. If any element of your three-gate system feels unclear or marginal, treat it as no. Clear confirmations are rare. Marginal setups are common and dangerous. You own your process, not your predictions, because markets reward discipline and mathematical precision, not opinions about future direction. Your process generates edge through systematic decision-making that filters emotion and randomness. Your predictions are entertainment that often conflicts with profitable action. These four principles cut losses fast. Size small. Wait for confirmation. Own your process will serve you better than any complex indicator, secret method, or insider information. They form the foundation that supports all profitable trading, regardless of strategy, time frame, or market conditions. Professional pyramiding requires reading multiple confirmations simultaneously. Your position must show profits. Risk must compress. Reactions must validate strength, and market structure must remain intact. When any element weakens, you stop building and consider defensive action. This systematic approach eliminates the emotional decision-making that destroys amateur accounts. Consider Livermore's 1929 restraint as your template. While others pyramided into overvalued markets driven by speculation rather than value, he waited for mathematical confirmation that never came. His patience preserved capital for the crash that followed, allowing him to pyramid short with compressed risk and confirmed momentum. His restraint during the bubble was as profitable as his action during the crash. Close the nested loop that opened our entire discussion. This is precisely why your second edition feels safer than your first entry. Each layer tightens the mathematical net while the market pays for your size through confirmed profits and structural validation. Your risk decreases as your position grows because higher prices allow tighter stops, better average costs, and systematic confirmation at every level. The three gates stand as your permanent filters: proof test, compression test, reaction test. Pass all three, and you've earned the right to build. Fail any one, and you wait for the next opportunity. This binary approach eliminates the gray areas where amateur judgment destroys professional discipline. Master the discipline of safe scaling through proven methodology that preserves capital while capturing trends, and you're ready for the next level of professional position management. How to exit pyramids like a systematic trader, scaling out portions while keeping runners alive for maximum profit capture. The same mathematical precision that builds positions safely also exits them profitably, transforming pyramiding from account killer into wealth builder through systematic discipline applied consistently over time.